Okay, good afternoon, everyone. Thank you for tuning in today's corporate briefing session. My name is Kenneth, an analyst from M Plus, and I'm the moderator for today's session. We have with us today Mr. Adrian Low, Managing Director of OM Materials Singapore. Just a quick introduction of OM Holdings Limited. The group started off since 1994, growing exponentially and was subsequently listed on both the Australian Stocks Exchange and the main market of Bursa, Malaysia. With over 20 years of operational history, OM Holdings is now regarded as the largest vertically integrated manganese ore and ferroalloy player in Southeast Asia market and the world's leading supplier of manganese ores and ferroalloys. Their products are distributed throughout their global trading network to top regional and global steelmakers around the world. Over to you, Adrian.
Thanks, Kenneth. Thanks for the introduction, and hope everyone can see the slides. So, thank you for taking time this afternoon to hear our sharing. So, I think you can see that that's our plant at Sarawak on the cover page. But I think maybe today I'll sort of introduce the company very briefly for those who are new to us, if you've not sat in any of these briefings, and then talk through our first half earnings before leaving time for Q&A at the end. So, I think OM Holdings today, is very much a smelting company. I would say we're a processing company. Historically, I think, we've had upstream mining and downstream, sort of trading. But today, the core business is in smelting, and the basis, behind smelting is really it's all about the power, right? So the key asset or entity that we have today is our plant in Sarawak. What you saw on the cover page, and that is powered by sustainable hydropower. So that was the main draw for us: one, renewable energy, and two, the cost competitiveness of that energy. So we're listed both on the ASX and on Bursa, and I think we were the first to be dual listed on both of these exchanges, and I think we remain the only one. I'll talk more about cost competitiveness and so on in the later slides. But suffice to say, I mean, our operations are mainly in sort of traditional manganese-related countries such as Australia, South Africa, as well as a sort of larger presence in Asia. So with that, I'm just going to talk briefly about our operating assets. We've put smelting right on top now, so you can see, Sarawak smelter. We own 75% of that. It's the line right on top. Has a capacity of about 400 to 500,000 tons per annum for ferroalloys. And we most recently announced that we will be completing this acquisition of the remaining 25% of the plant from Cahaya Mata Sarawak. CMSP is has been our JV partner from day one. I think we're very thankful for their support leading up to this point. But I think they have other sort of strategic priorities they would like to pursue, and we of course would like to have more of our own asset. So that is the main plant. We also own a smaller plant in Qingzhou, China, but I think that was our first foray into smelting more than 15 years ago now. And that plant currently is closed actually because of this very, very prohibitive cost of power in China. So that's the core business. Upstream, we have exposure to mining. So if you look at the bottom left corner, we have our plant in Australia, our mine in Australia, sorry. We used to produce 800,000 tons per annum, but now that is closed. So what's left is a tailings retreatment, where we're looking to recover all the waste material that has been generated over the last decade of mining. And so not only is that cost efficient because you're just reprocessing the waste, it's also also allows us to in the process of doing that, move material and complete rehabilitation for the mine. Besides our mine in Australia, we also own 13% of a mine in South Africa. So the Chippy Ball mine is actually one of the world's largest manganese ore mines. So you can see the capacity written there, 3 to 3.6 million tons per annum. So actually half of this asset, coincidentally, is also listed on the ASX under the ticker GMS, Jupiter Mines. So, if you're interested about our upstream business, you can take a look at that as well. So, to sort of round it out, we have our third leg of the business, which is the marketing and trading operations. And what that really is procurement and sales and distribution of all the products that are related to smelting, as well as logistics. Okay, so just a quick, here I'd just like to speak briefly about what the products are. In case you're not familiar with manganese, manganese ore is primarily used to produce manganese alloy. Manganese alloys, like its name suggests. So, over 90% of manganese ore consumption ends up via the alloy pathway into steel. And, at our Sarawak plant, we produce not just manganese alloys, we also produce silicon alloys. So these are two families of products that we produce. For manganese alloys, it comes from manganese ore. Silicon alloys comes from SiO2, which is basically quartz. Okay, the easy way to think about alloys, ferroalloys in general, is and the analogy we always use is it's like how a restaurant uses salt. So the steel mills have to buy the ferroalloys, so they have to consume them, but at the same time, it's also a very small fraction of the cost, 1% or even less. So for every 1 ton of steel, 1,000 kilograms of crude steel, it doesn't matter whether it's basic sort of rebar for construction or high-end electrical, grain-oriented steel sheets, and all steel in the world needs ferroalloys. And for every 1,000 kilograms, you can sort of say between 10 to 20 kilograms of ferroalloys would be needed. And that is what we supply. So the interesting thing about ferroalloys is that there are no known substitutes. It's a very fundamental aspect of steelmaking, and it cannot be recycled. So unlike steelmaking, where you have the blast furnace route and you also have the electric arc furnace where you're melting down scrap, the same is not true for ferroalloys, because once it's gone into the steel, it's gone basically. Okay. So here we just have a quick slide, showing the beautiful Bakun Dam. So the Bakun and Murum HEPs, hydroelectric plants, combined generate 3.3 gigawatts of power, and that's what our plant is running on basically. Okay, so smelting, sort of going back to the process of turning these ores into alloys, right? I think it's very easy to understand, sort of very intuitive way, because you need to melt these rocks at very, very high temperatures, and a lot of power is required. So when you look at one, you look at the picture, it's glowing sort of molten metal, and number two, look at the cost curve. So the two important things I think that I always say are, one, the share of power, that's the orange part, is very, very big, regardless of where you are. Okay, number one. And two, we're all the way on the left of the cost curve. So this cost curve is a bit old, it's a bit dated, but I think sort of, if I could just talk through the main changes between what has happened, in the last, say, 12 to 24 months, or 12 to 18 months, has been that the cost of power for everyone has increased, I wouldn't say exponentially, but by sort of multiples. So that is true for China. It's also true for Europe. So when you look at the cost of power, the share of cost that power takes up in China and France and Spain, right, that is now many, many times higher. So it's also pushed up the sort of supply curve into a much, much steeper angle. So that is one change that has not affected us, because our power is contracted for 20 years. it's fixed, no moving parts. Although it's denominated in ringgit, so obviously when you convert to USD, there's a bit of volatility there. But that's essentially it for us. The real difference, the cost component that has changed the most would be reductants. So that would be like coke, semi-coke, coal, and that has increased, across the board for everyone essentially. So that's quick introduction to the cost structure. And in this chart, we actually chose ferrosilicon, but the same logic really applies to all of the ferroalloys that we are smelting. Okay, so we have been listed on Bursa for sort of over a year now, and we just launched our inaugural sustainability report. So obviously, for an industry like ours, where although it's essential to steelmaking, and steelmaking is essential to modern living basically, it's often viewed as say a heavy industry that is environmentally unfriendly. But I think that is actually not the case. I think we are doing what is necessary. We're producing what is necessary for the world in the cleanest and most sustainable way possible. So number one, if you look at the chart, we've actually sort of disclosed all our emissions on a per ton basis for ferrosilicon and manganese alloys, both scope 1 and scope 2 emissions. And because we predominantly run on hydropower, this is based on data from Sarawak Energy, our scope 2 greenhouse gas emissions are actually 75% lower compared to conventional smelters, right? So conventional smelters are in places like China, Russia, Ukraine, India. Of course, not all of them are run on sort of coal-based power, but the vast majority of them are, right? So I think it's important to sort of frame this what we are doing in the context of what's happening in the world. So besides emissions, I think both sort of across the E, S, and the G fronts, suffice to say, I'm not going to go through all the points, but we are committed to producing what we're doing, producing what we are producing in the most responsible way possible. And so, by default, obviously, we comply with all the necessary guidelines in terms of air, water, and as well as waste, right? So that is I mean, these are all aspects that we're focusing on, and these are our targets, key targets for 2022. Obviously, there's a lot more metrics that are disclosed in the sustainability statement. So invite you to have a look there if you're interested. Okay, so with the introduction out of the way, I'm just now going to talk very quickly about our first half earnings. So if you've been following the company, or if you're new to the company, that's fine. But essentially what we went through in 2021 was a huge sort of mega commodity rally across the board for many commodities, right? Not just ours, but for ferroalloy prices, they peaked in Q3 last year, at the end of Q3, so between September to October. And I think it's no surprise that after peaking, prices will come down, right? And so a lot of people have been asking us about our first half performance. So I think we're very proud to say that number one, obviously we did better than first half of last year, so that comparison. And number two, even with prices coming down so sharply now into the middle of this year, our first half of 2022, we generated over $100 million of EBITDA. It's still higher than our second half 2021 numbers, and likewise, profit after tax to owners. So on two owner basis, it's about $50 million here. I think on fully consolidated basis, it's about $60 million. So I think we have demonstrated that cycles will come and go. That's the nature of commodities in general. But it's important to be able to sort of ride your wins, right, and sort of stretch out the profitable period for as long as you can, which I think we have sort of demonstrated. So not only that, if you look at cash flow from operations, our cash generation has always been very closely tied to EBITDA. So generating over $70 million in the first half of 2022. This number is in fact actually higher than what we generated in the entire 2021. Right? So I think this is quite significant and something worth mentioning. Okay, so moving on to a sort of market review and production guidance. So if you have been following us on attending quarterly webinars and what have you, you will have heard this before. But basically, just to give a very quick flavor, prices have come down quite a lot in the last 6 months. But obviously, we were able to sort of generate turn that into a very what's the right way of putting this? Take hold of the opportunity and generate as much profit as we could have. And we did this by, one, selling forward a lot at the end of last year, and two, front-loading production this year. So if you look at the production numbers, we are still on track to reach about 350,000 tons per annum this year, but we did 69,000 tons of ferrosilicon and we did 121,000 tons of manganese alloys in the first half. So that means first half is going to be higher than the second half. So just a quick note on the market. I think we are at the point in the cycle where prices have come down, and a lot of our competitors have been shedding output. So when you look at Europe, when you look at China, India, a lot of the reports that we're reading are sort of double-digit cuts in production. So, for example, China as a whole, I think ferrosilicon fell by, say, 20% month on month, and led by Ningxia province, which sort of is the marginal producer in the region. And when you look at India, depending on which reports you read, depending on the provinces, some of them actually cut production by 40%. So I think we are really at the point in the cycle where these prices are hurting our competitors and they're being forced to cut. Whereas for us, I think we're still chugging along. So it's very important in the commodity space to be able to sort of control costs and manage things at the bottom of the cycle and sort of ride those winds, like I was saying earlier, at the top of the cycle. So with that, I'm just going to talk about, talk through some of the numbers very quickly, but I'm not going to read all the numbers. If there are questions, we can answer them later on. But in the first half of 2022, our GP margin reached its highest ever, 27.7%. And revenue obviously was quite a bit better than the first half of last year because of pricing. But I think what's more significant is EBITDA, and I think here we've shown that the contribution from trading and associates, which is our investment in South Africa, has more or less been stable. But we have demonstrated that smelting alone, our smelting strategy is able to contribute the lion's share of profits, right? So this is a bit of a repeat from last year, and situation is quite different from a few years ago, like 2018, where mining contributed quite a bit of P&L. So next slide. Okay, so here I just want to talk quickly about cash generation and our gearing ratio and what we're thinking about in terms of our capital structure. So I think we have brought our gearing ratio down, from over 3 times a few years ago to 0.54 today. And the idea is to target a sustainable level of debt, right? And I think as we continue repaying down debt, which we have done for the first half of this year, we repaid 36.9% million US dollars in debt. We want to reach a point in which we can say, okay, this is the optimal debt level, and we want to sort of manage our cost of capital that way. And I think that probably will be some kind of a refinancing exercise in the next 1 to 2 years time. And with that, I'm just going to talk quickly about the second bit of the capital structure, which at the end of the day, you look at both debt and equity. And so I think on the equity side, we have heard a lot of feedback from shareholders, both retail and on the institutional side. And so I think what management is working on is to put together something and formally have a dividend policy in place, which at the end of the day, we get a lot of question on this, and I'll talk more about it in the last slide, but it's very important for shareholders to have visibility, to be able to sort of predict how the P&L will actually translate into cash flow, right? So that's a very quick note on that. Lastly, for this slide, the company snapshot slide, I think the key things to note: trailing 12 months EBIT P ratio, the last item on the left, is now 3.4 times. So I think that really speaks for itself. And I think I got this question previously also, which is why is there this liquidity issue on Bursa, and it seems that sometimes it's actually even lower than the primary listing, which is Australian listing. And so to which I think we will reply that the 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 entire premise behind listing on Bursa was to bring in a lot of institutional investors, and that actually the exercise has not been completed. So we just got our Sharia compliant status earlier this year, and if you've been following what we've been putting out, we have been reaching out to a lot of doing a lot of education, investor education, and reaching out to institutional investors. And unfortunately, that process just takes time. I would say the interest is there, and the idea at the end of the day is to meaningfully transform the company ownership into one that is much more institutionalized, and thereby improve both liquidity and also recognition, I think, for the company and for the industry. So, I think being the first smelter, ferroalloy smelter to be listed on Bursa, and actually we are, literally one of the few in Asia Pacific in this part of the world. The process does take time, so we thank shareholders for bearing with us, and understanding. Hope that by sharing these dynamics, you have a better appreciation of what's going on. There have been some questions on just placing out shares to institutions, and I think that's probably something that we have to be sensitive to the share price, and also sensitive to the interests of existing shareholders. So that is something that we'll consider, I think, only when there's a meaningful recovery. So with that, I think with the last two slides, the plan, I think, for us was always to focus more on manganese. Unfortunately, because of the project finance structure, we had to start with ferrosilicon. But this year we have basically been delivering what we said we'll do at the start of the year. So this slide has been around for a while now, and we said we'll convert 2 furnaces from ferrosilicon to manganese. So that's the first +2. We've done that. And if you saw announcement, we actually commissioned those in June and July this year. And then the second arrow +2, that is from ferrosilicon to metallic silicon. And just a quick note on that. When we convert to metallic silicon, we'll be tapping on to a completely different market altogether. So, we will be, metallic silicon essentially is used in a lot of industries. It's used in the aluminum industry. It's used in sort of chemicals for silicone production. And it's most importantly, it's used in the solar sort of downstream. And so, that for us is very meaningful, because one, we want to be part of the renewables solution. We want to be part of that supply chain. And two, I think, from a very strategic perspective, most of the world's silicon metal now is coming out of China. So, it is meaningful to produce it in Malaysia, which is, very, very politically neutral country, and not subject to a lot of taxes around the world, import taxes, I mean. And so, that is our first foray into a non-ferrous, in that sense, non-steel applications. So with that, once we complete all these exercises, the plan is to put on 2 more new furnaces, larger ones. So that's a green icon you see on the left at the bottom, and that will take us to about 600 to 650,000 tons per annum of sort of capacity. So this is for everything, right? But keep in mind, if you just look at manganese, we will be about 500,000 tons. Call it, I'll call it 500,000 tons. And when you look at the world traded volume of manganese alloys, it's probably about 3 million tons. And so, we will be a meaningful fraction of the world market once we complete all these exercises. And I think this will probably be in the next 1 to 2 years' time. Okay, and so with that, we've come to the last slide. I think, you know, uh, about 30 minutes in, so leave more time for Q&A. But, you know, I think a lot of people have asked us, will ask me what the outlook is and how things are going to go now that, you know, one boom is over. To which, you know, it's never about the current boom. You know, it's about being in an industry where you know you have this moat, you know that you can ride the booms and you know, withstand the low points in the cycle, and that, you know, your long-term average margins multiplied by volume is what sort of delivers value. And I think for a lot of shareholders, you know, we will sort of prioritize growth at this point, complete the exercises that we need to, and then, you know, post that, you know, post all the plans that we've outlined, then focus on, you know, how do we meaningfully distribute earnings to shareholders. So I think that's really the key message. And you know, it's not about, again, you know, the current cycle, is it up or is it down, right? But are you in an asset? Do you own an asset that fundamentally can, you know, generate these supernormal returns in the good years and sort of withstand the bad years? And if so, what are the average earnings? And so I think, you know, today when you look at the power prices, you know, you just Google natural gas prices in Europe, right? And the power prices in India, in China, you will see that just from the power price alone and what we're paying in Sarawak, there's a very meaningful spread. And that alone, right, ignoring everything else, ignoring the margins that those smelters themselves have to make, is the moat, right? And that allows us to generate significantly higher long-term average margins as compared to, you know, 3-4 years ago. So I think that would be the key takeaway. And, you know, and again, this is a simplification, and, you know, we've removed the distribution business and the mining and everything, but at the core of it, you know, this is the key value proposition for OM Holdings. So with that, that's the end of the presentation. I hope you know, that was insightful, and yeah, happy to take questions now.
Uh, Thanks, Adrian, for the presentation earlier on. Now we move on to the Q&A session, and I have some questions here from my end. Firstly is, after delivering a stellar first half of results, congratulations. We will
Thanks.
be expecting softer numbers in the second half of the year, given that ferroalloy prices are tapering since the end of last year.
Yeah, so the expectation for second half, right, versus the recent halves that we had, I think, look, prices are going down, so it's probably not realistic to assume, you know, similar performance for the second half. I think it probably will go down. You know, prices will go down until the inventory in the system is removed, right? So a lot of the producers are now cutting, you know, like I mentioned earlier, 20%, 40%. So once that is removed, then I think we'll see a meaningful increase in prices again. So when will that happen? Um, you know, I do not know, but I think things will be interesting when we go into winter, because that is when power prices tend to increase. And well, not in this part of the world, but definitely in places where ferroalloy production is very intensive, most notably North China, right, or Russia and Ukraine. So I guess you know, we'll have to see. But to answer your question, no, I don't think the second half will be comparable to the first half.
In continuation to that, your GP margins was recorded at about 27.7% in the first half. Will we expect GP margins to drop back to like mid to high teen level for the second half of the year?
Right. I can't comment on where it would drop to, but it will drop from 27%. So, you know, I think we were able to lock in a lot of the costs to secure that GP margin, right? So one, we actually bought a lot of raw material in advance of the cycle, and our power prices are locked in. And so as we go down, then the opposite is true, right? You have to start unwinding, I think those margins will then go back down probably to historical levels. But I can't quite comment on where that will be now.
Okay. Okay. There's concerns over demand sapping global recession, tighter
Hmm.
monetary policy, and persistent COVID-induced lockdowns in China that has resulted in weaker demand. How will the group ride out on this situation in this case?
Yeah, I think having seen quite a few cycles already, they are always the same. So it is always a period of competition between not just the producers and the traders, but also the end users themselves, because they will resist buying material, and in fact, they will destock as much as they can. So we just have to ride out the cycle and manage our costs effectively. That's one. Number two, we have the advantage of producing, 3 to 4 different products at our furnaces, and I think maybe 4 to 5 years ago, I think I probably said the same thing. Be more nimble in pivoting between products, and seeing at the end of the day what is the sort of highest marginal contributor on a monthly basis. And number three, I think having discipline in both purchasing raw materials and managing your sales. So sounds very straightforward. Actually, there's no secret sauce. It's really just controlling and managing all these things very tightly.
Okay. With the upcoming increase in production capacity, will we expect additional supply to be well absorbed and production to stay at current levels, which is around the 70 to 75% region?
Our own production, right?
Yep.
Right. Yeah. Okay. So I think this year we will be about 75% utilization. Next year, probably we will bring that up and try to reach full capacity at some point in second half of next year. So I think next year will be higher.
Expectation that the production to go higher, does this mean that like your new additional capacity will be well absorbed by like the by the addition additional demand? Or
Uh, I
have you secured like sales orders for that like your new for the new capacity?
Yeah. So because what we're producing is at the end of the day, it's a commodity. It's very sort of commoditized. There is no liquidity issue. Trading can be slow, but essentially there's no liquidity issues generally. As long as you are offering at the market price, we can sell the material. So in that sense, how we run our sales, maybe 50% is done on a spot basis. So N+1, meaning I sell in September, deliver in October, or N+2, all the way out. We also have contracts that are on a long-term basis. So these will be formula contracts, like average of a reported price for the month prior to shipment. So in that sense, I think we will be able to place out material. That's not the concern. I think the key concern would be then who are we pushing out, of the global supply chain, and I think that probably will be producers in developed countries where the cost structure actually doesn't really support industries like ours, and power prices are a lot higher there. So I think in the next 5 years' time, probably a lot of these plants will be closing, reducing capacity, and even in China, right, where they produce more than 70% of the world's everything basically, right? Ferroalloy, steel, uh, sorry, maybe not steel, but definitely for ferrosilicon. And the the thing is, for a lot of people that we're talking to, there's even talks that in the next 5 years, maybe China will be a net importing country, because the government is actually actively discouraging all these products. So for ferrosilicon, for example, China is the world's in Asia, right? It's the largest exporter. They're also the world's largest exporter. But for manganese alloys in China, they have no, they stopped exporting because they're not cost competitive anymore. So I think slowly this thing will turn the other way, and when China moves in the other direction, I think the amount of shortfall uh, in ferroalloys will be quite big. So I'm not so concerned in the medium to long run.
Okay. In regards to the two furnaces, uh, on the conversion of two furnaces for the production of metallic silicon that is expected
Mm.
to complete by end of this year, is that still on track? And have you secured any customer base for the new product base?
Mm. Okay, so we have a few customers on like non-binding. I would hazard to say MOU, but there's an understanding with them, and you can only really start selling when you first have the material on the ground, right? Because you're just commissioning. So that is on track. I think that's going well. In terms of the commissioning of the furnaces, I think what we're targeting now is to do that in December, and failing that maybe January next year. So I think commissioning probably will take a few months to figure out and stabilize the furnace. And thereafter, it will be a process of optimizing the raw materials. So what kind of grades can we reach? For now, we're targeting, obviously we want to produce the best. We want to be able to reach like solar grade. But if we can't, then how do you improve and sort of iteratively reach a higher grade? So yeah, I would say both commercial and engineering side are currently on schedule. So hopefully we'll be able to share more next year.
Okay. Will you be able to share with us what are the differences in margins between metallic silicon and other products, and who are some of the major players in the production of metallic silicon in Malaysia?
Yeah, the margin for metallic silicon is much higher than ferrosilicon. I can't share the uh, exact numbers now because I think we should probably, you know, disclose all that once we stabilize production. But suffice to say, because metallic silicon, the power consumption is almost double ferrosilicon, right? So per day, my furnace can only run, say, a fixed amount of power through sort of fed through the electrodes. And what that means is, even though I'm able to produce, I can produce only half the quantity compared to ferrosilicon. The margin per ton is so much higher that I will be doing better producing metallic silicon. So that's essentially the long and short of it. And this is true for commodity grade metallic silicon. That means basic products used in aluminum um, sector. And so if you go up the value chain and you pursue higher grades, then those margins can be much higher. Sorry, Kenneth, I missed the second part of the question.
Oh,
What
okay.
was
The second part is who are some of the major players of production that produce metallic silicon in Malaysia?
Yeah, in Malaysia would be basically PMB, right? Right on our doorstep, within the same Samalaja Industrial Park, and I think they're probably the biggest, and not really that many producers in Malaysia actually. I think the larger production base, like I was saying earlier, is probably China, and of course in the West, they have their own metallic silicon plants.
Okay. Given the advantages they have mentioned on the metallic silicon, are there like further plans to like convert other furnaces into metallic silicon as well after these two furnaces?
Yeah, I think definitely we'll be considering that, but we want to reserve our judgment until we sort of optimize production and then figure out the sales, and see how high we can go. Because if you can reach the highest possible grades, right, then it's a completely different story from just producing ferrosilicon.
Is there any update on the proposed acquisition of the remaining 25% equity stake in OM Sarawak and OM Samalaju?
Yeah. So no updates. We are supposed to complete the CPs this month, so we're still working on that, and it's a lot of conventional sort of CPs. Approvals from banks, from power company, shareholder approvals, and that sort of thing. So we're still working on it. Hopefully, once that's done, then we can complete the transaction. By the end of the year.
Okay. Early on in the presentation, you have mentioned that you want the shareholding structure to be more institutionalized. Is there any target on the proportion of a shareholding structure?
Um, I wouldn't say that we have a target per se, but at this point in time, we want to see meaningful institutional ownership, and sort of in double digits at the very least. And so this will be a process that will take time. Lah. It's not going to be overnight. Let's say, let's change all the shareholders, um, and again, having institutional shareholders, one, improves the trading liquidity because as a percentage, that volume will be much bigger, and two, at least a signal to a lot of shareholders who may be concerned that there are no institutional shareholders, or no significant institutional shareholders at this point, and that I think is a sort of a signal of confidence and quality of the company. So no short term targets. I think we'll work our way there, and then we'll see how things go.
Okay. In 2021, the production was partly affected by workforce shortages. Are you still
Mm.
facing this issue, or are we seeing signs of improvement lately?
Yeah, luckily no for this year. Um, and I mean, this year we did 75%, or I mean, we're targeting 75% utilization for the full year. So in a sense, the manpower that we have now is more or less sort of proportional to what our production plans are. So there aren't any impacts. I think next year probably we'll have to see how the China lockdown situation goes, because that probably will have an impact on the labor situation. But again, it's very difficult uh, to call how China is going to move from the current lockdowns, and definitely at least we'll have to wait until after October to see um, how that situation goes. But I mean, what we can do in the meantime is really just train more locals, and improve the upskilling process. And so this year we signed the MOU with Unimas, and that training program has begun. We're doing some trials also. So hopefully, the idea is to promote people organically upwards, because I was just sharing this yesterday as well. Smelting is such a high risk industry, right? You want to have the confidence that the person making the decision on the ground has seen enough situations, and he has the theoretical knowledge as well of what are the reactions going on in the furnace, what the normal temperatures should be, what the normal voltage patterns should look like, and so on and so forth. So that will just take time.
Okay. I think that's all from myself. We have some questions here from our listeners. How will the company sustain the revenue during the ongoing trade war, increment in OPR, inflation, and increase in raw material prices?
Oh, sorry, I ended the. Yeah, okay. So I just wanted to see the question clearly. Okay, so how do we sustain revenue, right, with the ongoing trade
Yeah.
war? Um, I think it goes back to what I was saying just now, which is to really control the costs. So in boom times, right, when let's say in the last 12 months, let's say, you want to make sure that you have more than sufficient inventory to secure all the high prices, because secure all the high prices on the sales side, right? And supply chains are very fragile. On when this unwinds, right, then supply chains actually become more lax. It's not as tight, and you can afford to say, okay, let me try to average down my cost in a more meaningful way. That's one. And two, on the revenue side, unfortunately, revenue is really just determined by your volume times price, right? So our volume is already fixed every year. We have the plan, and that's more or less what we commit to. So revenue is really just a function of that times price, and but on the sort of bottom line, it's the cost control I just mentioned, as well as being nimble with what you're producing. So do I produce silicomanganese? Do I produce ferromanganese? Do I produce, this manganese alloy family is actually quite wide as well. And so every day, every week, you should be asking yourself, should I be producing this or that? Should I be selling to Japan? Should I be selling to Europe? Should I be selling to US? What are the sort of freight changes? And if you are aware of what's happening around you, then that's the best way to sort of contribute, add value to the bottom line.
Okay. There's one question here on what is the target price for in the Bursa market. I think the management can't answer that, but based on our independent research report from M Plus, our latest target price was at 2 ringgit and 86 cents. You can read more on the company's report on our website. We still have a buy call at 2 ringgit and 86 cents. So I think that's all from the for the Q&A session. Thank you, Adrian, again for the presentation and also the Q&A session. And see you.
No problem. Thanks, Kenneth. Thanks for hosting.
Okay.